Well, good afternoon, ladies and gentlemen. Good evening or good morning. It's my great pleasure to welcome you to this Scope webinar, which we've entitled Open Banking and PSD2 Should Be More in Focus for Investors in European Banks. My name is Keith Mullin. It's my pleasure to be hosting this short session. I'm absolutely delighted as well to be joined by Sam Theodore, a senior consultant to Scope Group, who's going to give a short presentation in a second on the increasingly critical subject of digitization in banking, and specifically within that broad theme, the impact and importance of PSD2, which is now, as you I'm sure will be aware, is in effect. This was originally the subject of Sam's regular column, The Wide Angle, back in late February, and we received such a fabulous response to that Sam was very keen to actually explore the subject in this format as well, to give you perhaps the opportunity to engage with Sam. Now, this is an interactive platform, so as Sam is going through and speaking on the presentation, there is a questions function on the platform, and I do urge you and encourage you to put questions into the questions box as Sam's going along. And then at the end of the session, we'll go through as many of the Q&A as we possibly can. And just in case you or perhaps colleagues who couldn't make it today want to watch the session again, this event will be available for replay on this platform and on YouTube. And do circle back to us if you want more information or are unable to find it. So that's it from me. I'm delighted to hand the floor over to Sam. Sam, the floor is yours.
Yes, thanks, Keith, and thanks everybody for showing up, because basically we are in the midst of the results season, and I know everybody's so busy with these results, and today happens to be a busy day as well. So thanks for showing up, and I'll try to be brief. But I think that so far, listening to some of the calls with banks for the Q1 results, seems to me the bulk of questions are still on the traditional topics: asset quality, capital, revenues, M&As, who's going to merge with whom, who's going to buy which bank, which is all fine. But I think that increasingly the tendency is for the banking industry to move as it moves into the digital space, for the priorities to change. And I'm here today to tackle this topic of the new frontier of disruption for the European banking sector, which is open banking and PSD2. I hope you can hear me. Somebody apparently cannot hear me, but I hope everybody else hears me. If not, let me know. So basically, looking at the broader issue of this competition between banks and fintechs, I see three key drivers for it. The first one is the customer experience. The customer wants to be exposed to the digital more so. These days, for us, for most of us, the bank is an app. The bank is not the branch in the high street any longer. The branch in the high street, where in the past we would rush during lunch breaks to queue to do our transactions, that period is gone. Now, in terms of customer experience, I think that banks are quite good at offering an online service. I don't think that the bank which is not offering online products and services would have any chance to survive in today's market. So I really don't see a clear competitive advantage for fintechs in the area of customer experience. So bank can be quite good. Banks like Lloyd's and banks Sogen and others on the continent, ING in the Nordics, banks are quite good at keeping their clients with an online offer. The second driver is financial inclusion, and this is actually one criticism in the past, that banks are not inclusive enough and the large segments of the population do not have bank accounts, cannot have bank accounts. This has been true, especially in emerging markets, and of course, the two largest fintechs in the world, the subsidiaries of Ant Financial and Tencent in China, have taken advantage of this huge opportunity, especially in the retail financial services and payments in China, which was not properly covered by the banks there. And now each of them has almost 1 billion active users. The same situation we find in another large emerging market region in Africa, where M-Pesa is the largest fintech in the area, headquartered in Kenya, but with activities elsewhere in Africa. And again, Africa is a market, sub-Saharan Africa is a market with a very low penetration of the traditional banking industry, but a much higher penetration of mobile financial services. Same in South America. Nubank, which is actually a Brazilian neobank, I think is at this stage the largest neobank in the world in terms of number of customers, some 35 million customers, half of them coming last year through the pandemic when people had to stay home. And this topic of financial inclusion is also to some extent true in the US, because in the US, almost 25% of households do not have a bank account or are underbanked. In other words, they cannot benefit from financial services because their balances in the bank are low. So in the US also, the fintechs and neobanks have found a good ground to grow and be successful. Although the large banks are quite good also at offering digital-only alternatives, banks like JP Morgan, Bank of America, Goldman Sachs with Marcus, and a few others. Now, the situation, I would say, is different in Europe, and that's why I don't think financial inclusion is such a major topic in Europe as it is in other parts of the world, because I'm not talking about Western Europe. In most cases, banks' penetration within the population is almost 100%. So 99% of people have bank accounts, and the banks are quite good at keeping their customers lined up. So that's why we talk a lot about banks like Revolut and N26 from Germany, and Manzo and a few others. But if you really look at the numbers, first of all, these banks are not profitable. And number two, their number of clients is still small. And not surprisingly, in order for them to become profitable, they are moving beyond Europe. Both Revolut and N26 trying to move into the Americas. Revolut tries to grow in India because by staying solely as challenger banks, as neobanks in Europe, even in the UK, it's not likely that they're going to become highly profitable anytime soon. I think the only bank which says it's profitable now is Starling Bank, a smaller bank in the UK. So that brings me to the third driver for this competition between fintechs and which are encroaching into banks' market, which is payments. And payments is really the area where the banking industry in Europe is threatened. And it's threatened primarily because of this regulation, which came into being a few years ago, which turned into law 3 years ago, and which is about to be implemented. I think the last deadline, the drop dead deadline for implementation is September 2021. And I'm talking about the second second payment directive, PSD2, the second payment services directive, which basically revolutionizes the payment industry across Europe. How? By allowing the transfer of customer financial data, the ownership of this data from the bank to the customer on open APIs to which third-party providers, TPPs, would have access, of course, with the agreement of the customer herself or himself. these TPPs, third-party providers, can be either account information service providers or payment initiation service providers. These are technical terms, but they're quite important because the first one refers to simply having access to the information, to the financial information, but not being able to execute transactions for that customer. The second category, payment initiation service providers, they can do financial transactions, of course, everything solely with the customer's agreement, which in essence puts in play almost 1/3 of banks' revenues on aggregate, revenues related to transfers, to payments, and to account services. And this percentage of 1/3, I got it from a recent comprehensive McKinsey study on which was trying to break down the profitability of the industry on aggregate in Europe. So this is very important. So it's significant not only for banks to comply with PSD2, something which they have to, or to be aware that PSD2 is going to be very important for the development of the sector in general, but actually it's very important for banks to include in their strategies and to think again their business models. Because those banks which will simply decide to comply with PSD2 without actually doing something active about it are likely to lose the game. Not surprisingly, many banks actually are becoming themselves TPPs. By the way, to be an authorized third-party provider, this authorization needs to come from a supervisory authority, which are the national competent authorities in the European Union and the FCA in the UK. I understand there are several hundred TPPs now registered in Europe, large number of them in Germany, also in France, a few of them, and over 400 in the UK. So the big question is not so much what are the large banks going to do, the INGs, the BBVAs, the BNPs, the SOGENs, but rather how can the smaller banks, the second-tier banks, react and remain competitive when they will have to have open APIs on which third-party providers can have a peek at their customers' financial data. Again, with the customer's agreement, always. And by the way, in these customer agreements, you have what it's called the 90-day rule, which means that every 90 days, the agreement lapses unless the customer specifically renews it, which I think is a very good measure to prevent abuse by the TPPs. Of course, the TPPs are not very happy about it, but they will probably have to live with it. So I think that the second-tier banks, the smarter ones, the digitally savvy banks in this category will have to be more active in becoming themselves TPPs. And I'm talking here about two specific services in this new business model, banking as a service and banking as a platform, BaaS and BAAP. Now, banking as a service is what used to be called in the past white label banking. So banks which will clearly provide banking services to other non-financial brands. And I think that the second-tier bank, which is well equipped to do that, even if it loses some customers locally, they can still do these services and generate fees and revenues. And banking is a platform, something which is done to some extent now in the Nordic region, is the bank opening its platform to third parties, to TPPs, to offer their own services. I think banks like Nordea, like DNB, like Danske, and also ING has a platform which quite performing, Yolt. It's called Yolt. So these are some strategies which enable banks to pursue successfully their activities in the open banking times. Now, coming back to the fintechs for a second, it's not surprising to look like which are the largest fintechs, European fintechs, in terms of valuations. And what we find at the top, we don't find the neobanks, the Revoluts and the N26. We find the payment platforms like ADN in the Netherlands, Nexi in Italy, or Checkout in the UK. So I think that this is really very interesting for banks to know where the direction of travel is and where the main competitive drive is going to come from. In addition, increasingly you have so-called independent open banking platforms with odd names like Tink, like Aya, like Bud, Mambu, TrueLayer, or Plate. Probably you wouldn't have heard of many of these names. I'm pretty sure you'll start hearing about them in the future because many are actually thinking of listing themselves as this business model seems to be now very hot with market participants. In terms of the implementation of PSD2, so basically one hurdle has been for a few years an agreement on the strong customer authentication SCA parameters. The EBA came with a paper which clarified all these parameters, but of course it takes some time for not only for the smaller banks, but especially for thousands and thousands of merchants to get up to speed with these new norms and be ready for PSD2. And that's why the deadline has been postponed, especially through the pandemic year, and is now September 21. Another hurdle for implementation in Europe has been the existence of different standards. Now, increasingly, the so-called Berlin standards seem to be adopted by more and more banks. Now, all these teething problems existed to a much lesser extent in the UK. Why is that? Because in the UK, and again, the UK was part of the EU until early this year, the UK decided to have a somewhat different approach to implementing PSD2, a more standardized approach, which I think is very positive. And the Competition and Markets Authority, CMA, decided to enforce these rules, these standards on the top on the 9 largest financial institutions in the country, the so-called CMA 9, which are 8 banks and the National Building Society, which means that the customer financial data is downloaded on the apps, on the APIs in a standardized form, which makes life easier for everybody, including the TPPs. Not surprisingly, the open banking concept seems to take off in the UK, although I would say it's still marginal. The open banking enthusiasts think that in the future this is going to be the predominant business model. I very much doubt. I think that the incumbents are not going to let this market leave them without a fight, and I think they're very well positioned to keep their market position. It's only that more and more this idea of transparency will permeate among businesses and individuals, and the expectations will grow, and of course we'll see more and more this concept of open banking being in the mainstream without, again, in my view at least, becoming predominant. That's just one point in the end to mention that in this respect Europe is leading the world, so I could see no other regulation similar to PSD2 in terms of forcing this openness in payments and transparency in financial transactions. But at the same time, this concept of open banking is now being adopted or at least studied in countries like Japan, Singapore, parts of South America like Brazil, and increasingly being discussed in countries like the US and Canada. I will close here, and hopefully you have some questions and we can continue the dialogue. Thank you very much.
Okay, thank you very much for that, Sam, for those insightful comments. So to those of you dialed in, please feel free to type questions into the question facility. While we're waiting, Sam, actually, there is one question that I'd like to ask you, if I may, which is it's sort of, you mentioned it in your presentation, but in your original wide-angle comment about this, you wrote about tectonic shifts and irreversible repositioning, and you said PSD2 is potentially the most important European piece of non-prudential financial regulation for decades. And this is pretty forthright stuff. And yet, as you pointed out at the beginning of your presentation, a lot of the analyst narrative, and certainly the media narrative, continues to be focused on, as you said, management issues and management changes, profitability, share prices, cost control, and sort of financial solvency. Given what's at stake, if you take the PSD2 and the digitalisation to the nth degree, why do you think that there's a mismatch of kind of interest and focus?
I think that you're quite right, Keith, to mention that. I think that especially after the financial crisis of 2009, the market and the banks and everybody was focused on prudential regulations, because that's what was about to tank the banking sector, not non-prudential regulations, or not going by the non-prudential regulations. So you're talking about capital, about liquidity, about funding, about asset quality, about all these criteria that everybody's focused on these days. But at the same time, you have this non-prudential part which is growing, and which includes this regulation, which in my view, so in general, the prudential regulations, while being harsh on the banks, they also raise entry barriers. So you have a non-bank saying, why do I want to become a bank and start complying with capital ratios and liquidity and this and that? PSD2 actually lowers entry barriers, because basically it tells the banks you no longer have a monopoly on payments, which is the backbone of banking transactions. You have to put them on an open platform, and if there are others better than you or more efficient than you in offering the same services, that customer should be free to choose those third-party providers versus you. Now, of course, if you ask banks, they all will tell you, we comply with PSD2. If you ask banks if they think PSD2 is important, they'll say, yes, of course, it's very important. It revolutionizes, it does this, it does that. But the question is, to what extent is the bank actually trying to adjust and to become a proactive player in this new world? Because if you simply dare to defend your position and to say, well, but we offer a better service than the TPPs, we shouldn't worry about that, instead of yourself becoming a TPP, yourself going after other clients. And that's actually, in my view, a way to boost market share in the future, not by merging with other banks, which is basically merging one legacy structure with another legacy structure, but going after other clients through open platforms. So I think it sinks in slowly, because the market has been so focused on the aftermath of the last financial crisis and asset quality and NPLs and all these things and buffers. But I think that increasingly the focus on digital will become more predominant. I hope so, at least.
Yeah, indeed. Okay, thanks. Sam, there's a question that's come in from our audience, which you can have a look at. I'm going to take a risk of asking you anyway, which is about BAAP. And the question is it possible to see SME banking as a real area where the Nexis will eat the bank's lunch? Or is the loss of retail personal banking to the likes of TransferWise more serious? It's more of a sort of segment kind of question.
Yeah, I think that, that's really a guessing game here, but I think that SMEs would be more inclined to take advantage of this new, because the bottom line, the SMEs have a keener look on their bottom line that individuals in general. They are, on average, on balance, not as a rule, but on balance, I think that SMEs are more financially savvy than a large number of individuals. So I think that the SMEs will be the first to take advantage of this, and also the early adopters. I mean, among individuals, you always have technology enthusiasts, early adopters who, those people who trade in crypto assets and all these things, which will probably will look at these new platforms.
Yeah, just on that, if I made it as a follow-on, do you think there's a danger from a customer side of inertia, customer inertia on the retail side, just maintaining the status quo? Because it's all well and good saying, well, you have open banking and APIs, these kind of notions and and these acronyms that you mentioned, they're kind of pretty terrifying to most consumers.
I don't think that banks, or I don't think that, and looking at the website of some of these TPPs, I don't think they use these acronyms. These are more like regulatory acronyms, and regulators love to use acronyms. They have an acronym soup at their disposal. But I think that when you look at what the direction of travel is, yes, you'll have a lot of inertia, and I think that one major danger is to have an accident, something like a TPP disclosing customer information or being hacked, or this sort of things. And then the confidence in this new concept will probably dissipate very quickly. So I think it's still a big question mark, but it doesn't mean that banks can say, let's count on our customers' inertia, let's keep doing what we have been doing in the past. So okay. It's pretty dangerous to say that.
Yeah, makes sense. There's another question, Sam, that's come in, I know, which is on a subject pretty close to one of your core interests, which is how banks can address the cyber risks that are inevitably raising with the revolution in open banking. I guess cyber risk is something which goes hand in hand with digitalization.
Well, obviously, this is I would say, it's the major risk in the digital age. And increasingly, when you say cyber risk, it's increasingly, for example, misconduct like money laundering is also, these days, could be a subcategory of cyber risk, because most of money laundering is in the cyberspace these days. So cyber risk is a major issue. Banks address it. They don't talk too much about it. Nobody talks too much about it. But this is definitely a massive, massive challenge. The good news is that when banks started to operate in the digital space, cyber risk was an afterthought. So they first look at the opportunities, and then they realize we also have risks here. With these platforms, with these new elements, I think cyber risks are there from the beginning. So at each step of the way, these cyber walls will be in place, encrypted information and all these things which now exist, which a few years ago did exist, but more marginally. But definitely this is a major, major issue. And you'll probably hear a lot of that coming from the banks.
Yeah, absolutely.
And the regulators, yeah.
Yeah. In your comments, Sam, you mentioned in passing, I guess, big tech. And there's a question about big tech here. And the question is it only a matter of time that they apply for and get TPP or even full banking licenses? And then there's a segmentation question. Is their audience millennials and Generation Z, or so-called pioneer customers? Or could it be a broader threat?
Well, I think that the big tech, big tech can be TPPs. I'm not sure if Amazon applied or not to be a TPP. And the big tech can buy banks. And at some point in the US, there was talk about Amazon offering current accounts in conjunction with JP Morgan. I don't think that's still the case. If I were a big tech, I would think, do I really want to become a bank and get regulated and get prudential ratios and get compliance issues and triple my compliance staff? And big techs themselves are now under the scrutiny of politicians and governments for more regulation. So more regulation of the big tech industry is likely. So I'm not sure that they would look at regulated banking as the most profitable segment in which they could get. But again, big tech could do things like Facebook doing this Libra project which is now called DM, which deals with which will trying to bring a new private cryptocurrency, asset-backed cryptocurrency in the market. Or lately they said they can act as a white label for central bank digital currency. So big tech is going to be active in a way or other, having a customer database. But when you think about big tech, you shouldn't think only about Amazon, Google, Facebook, Microsoft. Also think about other businesses which have a huge customer base, a financial base of customers like Uber, like Airbnb and others. Definitely.
Indeed, good question. Sam, there's quite a specific question, which I'll pose it to you and then see how you get on with it, which is, how do you see the upcoming trend of embedded finance / bank by BaaS providers? Do you think traditional banks are prepared for this? That's quite a technical question, so maybe you may want to consider that one, but do you have any immediate thoughts?
Well, basically, I think the question is about BaaS, banking as a service. I think that I mentioned that in the presentation. I think traditional banks should consider that. I think they should consider, and actually in the past, it was called differently. It was called white label banking. But I remember that in old times, Royal Bank of Scotland was doing white label banking for Tesco and things like that. So I think that technically speaking, it's possible. And I think second-tier banks, which feel under pressure, under market pressure, and which may not have a future if they don't act now, some of them may consider to become more digitally savvy and engage into these activities. Absolutely.
This is, I guess, there are no more questions for the time being, but one from me, Sam, if I may. You talked in your presentation about the challenge, really, of more second-tier banks in actually just meeting the requirements of this revolution. And we have seen examples of banks merging so that they can create bigger IT budgets, which is partly to do with engaging with the process of digitalization. And so do you have any sense of this process, not necessarily PSD2 per se, but digitalization more generally, driving more banks to consider merging? And as a sort of related question, I mean, how, what's your read of how important this process is, in the management ranks of second-tier banks?
Well, yeah, I think it's a very important issue, but I think when we talk about second-tier banks, we have to make a distinction here, because you have so-called second-tier banks. You have a large number of savings banks, for example, in Europe, in several countries like Austria, Germany, and others. Now, these banks are not totally independent. They're part of larger groups. In Germany, good example are the savings banks group and the cooperative banks group. So these banks don't have their IT independent of the other. So they have centralized structures for IT, for platforms, and all these things. So I think you really need to have more consolidation within these groups to have more efficiency. But then you have second-tier banks which are more independent, and which, again, I think they have a big issue of credibility in the market. How they're going to make money in the future if they don't have something unique or something very consistent, which is typical for them. So, on the one hand, you have a bank like Bank Inter, which you could say in Spain is a second-tier bank, but it is an exceptionally well-managed bank, which proved it through several crises, and which you can be confident they'll manage to survive this new era with some degree of success. But there are many others which are probably in a more difficult position. And I would include there UK second-tier building societies, with the exception of the top one, Nationwide. You can ask the question, what's the future of these building societies, especially if open banking takes off in Britain more than in the past. I cannot hear you, Keith.
Sorry, I went on mute, sorry. Sam, in terms of, you've been, I guess, exhorting analysts to ask more questions about these sort of topics on the kind of earnings calls. I was curious, though, in your own mind, in terms of the time frame over which this is all going to play out, this is presumably not an immediate term issue. You said the last hurdle, the last piece of the legislation on PSD2 is September, and then I guess events will take their course. But just thinking back, I'm very taken with this idea that you said that something like a third of all banks' revenues are derived from payments and payment-related services. That slippage, assuming it happens in the way that you perhaps might think, is this going to be a 2 to 5 year, 5 to 10 year, or perhaps more open-ended? Just a kind of blue sky question for you.
Yeah, I hear you. I don't think it's going to be 5 to 10 years. I think these things tend to move faster than that. Like all these technological advances, first they move slow, very slow, and then all of a sudden they speed up, and they cannot be stopped. And I think this is the time for the banks to say let's put their things together in terms of moving into digital in the right way, because on top of this payment revolution, you also have another revolution, which is that of digital assets. So increasingly you'll see the advent of crypto assets and digital assets in general, like in the tokenized economy. And actually, if you look at some pieces of regulation being proposed in the digital financial package by the European Commission last fall, one very important piece of regulation which is being proposed is markets in crypto assets, which is going to regulate the issuers and managers of crypto assets and digital assets in general in the future. And the banks there have another advantage to be the first in the field. If they don't take advantage of it, then others are going to come and eat basically their lunch. So absolutely, I wouldn't say 5 to 10 years.
Okay. So you heard it here first. The clock is ticking, and I was just about to close the session. And one final question is just coming under the deadline, Sam, which is this: do you think the typical bank analyst can judge tech prowess, given that almost all banks are good at spin doctoring on this?
Well, my answer is no. Obviously, a lot of bank analysts would need to recycle. We all need to become more technologically savvy if we can. Or we don't need to be, if you become a fintech expert, first of all, you're not going to be a bank analyst or a bank supervisor. But I think that you need to improve your understanding of the technology and to remain intellectually curious in this field. But at the same time, and that's very important, I think, you have to keep your anchor, you have to keep your roots into what banks are and what's their mission in life in society. Because if you lose it and you become too much enthusiastic about all these new technological achievements, then you lose track of what's important. So I would say you have to do both.
Yeah. Okay. Very good. Sam, on that basis, there are no more questions, and I don't have any of my own. So if it's okay with you, we'll close the session now. So thank you very much for your incredibly insightful, as ever, comments. And thank you to you in our audience who took the time out today to join the session on this very busy period as the Q1 earnings season is in full swing. So as mentioned at the beginning, this session is available for replay on this platform, and it will be available on YouTube. So thank you again for tuning in. I hope you enjoy the rest of the results season. And, if I can just repeat an exhortation from Sam, from the analyst side is, keep asking questions about cyber risk, about digitization, because these are going to be the issues that are bubbling under and getting more and more important as we go along. So on that basis, thank you and goodbye from us.